All right, guys, welcome back. Today I am here with my good friend Mike Roberts, and just like from the video we said yesterday, we're going to have a discussion here with Mike because he is the man behind everything that's coming with the Assumption loans. And he and I just met, what was it, just about almost 2 months ago, maybe a month ago?
A
couple months ago, and he came to me and was like, hey, we have the solution for all of the buyers now. It's this thing called Assumption loans, which was a term that I heard in like 2022.
Right.
Became really popular in 2023. But let's discuss, I want to have this conversation as if I'm a buyer and I just heard about this term, assumption loan, based off of maybe Josh's content or maybe even just through the grapevine.
Gotcha.
So let's explain to the audience here what actually is an assumption loan, and give them a little bit more background before we do that on you and how long you've been in the industry.
Okay, so Mike Roberts, I'm actually I call myself a native here. I know who Wallace and Ladmo are. If you know who Wallace and Ladmo are here in Phoenix, you're a native. You have a kind of a deer in the headlights look there. But no, I've been here for a while. Went to U of A, graduated engineering, then kind of traveled the world and ended up in finance in 2002. So I started doing lending here in the Valley.
And now you have your own lending institution, right?
Yep.
And the name of that is?
Cobalt Mortgage.
Cobalt Mortgage.
But now we're actually transitioning that to Yumi Home Loans.
Okay.
Because the assumption thing has really taken off.
It is.
Yumi Assumption Specialist.
It definitely has to. Not only is it a wonderful thing for agents that we can actually, educate buyers on, this is going to be a solution that I see for a lot of buyers that have just kind of been on the fence for the last, almost 2 years now. So going back to even just like the description, I was like, let's explain to people again, even just from you, because I know they've heard some information from me, what exactly is an assumption loan and how does that process actually work?
So, okay, a couple different things there. So the way I normally explain what an assumption is, it's what it's not.
Okay.
And so what it's not is it's one of those crazy contract for deeds subject to wraps. And I call them crazy, but there's a place for them in the market. But for your normal home buyer, it's not really the way to go. There's a little bit of risk involved with those, and that's not at all what they are.
Okay.
But a lot of people think that that's an assumption. Yeah, that's where you go over and you do this crazy little contract for deed thing that investors are doing. So an assumption, what it is a legitimate, it is above board by law takeover of someone's loan.
Okay.
And so the key difference between that, what it's not and what it is a release of liability for the seller.
Right.
So what that means is basically, so if I'm buying your house and I'm assuming your loan, so then Josh would come off the loan and Mike would go onto the loan.
Right.
So then you're completely released from all liability and the payments don't get made on the house, no big deal. Payment goes into foreclosure, no big deal for you.
Right.
So, because all the responsibility is on me now.
Wow. So that seems pretty easy. When people think of it, it's like, wow, I can assume somebody's payment and their loan at like a 2.875 interest rate, correct?
Yeah, we just had one at 2.375.
2.375.
That's the lowest one that we've done.
Wow. Yeah. And what was the loan amount on that one?
408,000, I think.
408,000?
Yeah.
That is beautiful. So that can definitely, guys, if you're paying attention, this can definitely be the solution for you. Now, that wasn't exactly the entire purchase price, correct?
No.
That was just the loan amount, guys. Right now, I really want you to pay attention for this. So what was the exact purchase price?
So the purchase price on this one was a little bit high.
Okay.
So it started at $695.
Okay.
And it actually got bid up to $750 because of the loan.
Oh,
so full price was actually $695 and it got bid up.
Okay.
That's crazy.
Wow. Because of this assumption loan.
Yeah, because of the loan.
Okay.
So in this particular case, it was interesting because the seller, the first thing that they thought of was I'd rather just close as fast as possible. So give me an offer with a conventional, normal, 30-day close type of thing, and then give me an offer with an assumption. And the difference in that price was about $50,000.
Wow.
Yeah.
Maybe like a 50.
People really wanted that low interest rate.
That's amazing. All right. Well, let's, because you and I have broken this down several times, and obviously we've done it with several clients, but just for the audience to really know and understand how this really works, let's go with a $500,000 purchase price.
Yeah.
And let's say there's an assumable loan of $400,000 at 3%. Easy numbers,
Perfect.
right?
Got it.
So we have a $500,000 purchase price. We have a $400,000 assumable loan at 3%. There's obviously a $100,000 difference there.
Right.
How does that actually get made up, and what do buyers need to pay attention to in order to make sure that they can fully purchase this home with the assumption and this $100,000 difference?
A couple different things there. So with the difference of $100,000, the obvious answer is if you have $100,000, that's your down payment. So in the assumption world, it isn't like new financing where it's like 3% down or 3.5% down or anything like that, because it's not a new loan. You got to remember you're taking over someone's loan.
Right.
You're taking over their term, their interest rate, their everything. So that delta that we call, it's the delta or the gap of 100,000. You either come up with that full amount, or there's a way you can actually finance a portion of that.
Okay.
So you basically get a second mortgage. It's called a piggyback mortgage. And if in the case of 500,000 and 400,000, you would be able to finance 50,000 of that and then come in with 50,000.
Okay, so not the full 100,000. So I know you and I have explained this before. So you're saying that 10% down has to be as far as the purchase price. So let's explain that to the audience.
So in the case of 500,000, you'd have to come in with 10% of the purchase price, which is 50,000.
Okay.
Now that is because that secondary financing demands that there's a down payment there. The assumption portion of the first loan, they don't care how much you actually get as a second loan. Or in the case if you're getting super creative, and you have a very motivated seller, you technically could get a second mortgage for that 50,000, and then the seller could actually carry another 50,000 or another 20,000 to make it so you can buy the house. So you can get super creative in there, so it's not super strict.
Okay. So with this secondary financing, what do you call it? The piggyback mortgage. Right?
Yep. All right, piggyback mortgage.
So this is actually a product where somebody needs to be prepared to have 10% down of that purchase price, correct?
If the delta is larger than 10%. There's properties out there where you might say there's a $350,000 sales price and someone owes $320,000 on it.
Okay.
So that's only $30,000 down. It's less than 10% down.
Okay.
Yeah.
All right. So that works out really, really good, guys. So let's explain this again. So $500,000 purchase price. There's a $400,000 assumable loan, and then you have to put $50,000 down because that's the 10%. Right. And then the other $50,000 would actually be on that second mortgage or that piggyback loan, correct?
Exactly.
All right. Now, what is the interest rate on this second?
This is where people get scared.
Exactly.
Right?
This is where the details come in, guys. So really, really.
This is where the education really comes in.
Yeah.
So let's say, for example, it's 50,000. You're probably right around that 11.5% range,
right?
11 to 11.5, and that scares people. That's
Absolutely.
the first thing they do. They're like, whoa, 11.5%. I can't do that on a mortgage, right? Because that's all they think of is it's a second mortgage. But the reality is, and when you're able to educate somebody and show them what the blended rate is, and what blended rate really means is, if you think back to high school, it's really just that weighted average.
Right.
So in the example of say that 500 and 400,000, you have a loan at 3% for $400,000, and then you have a loan at say 11%. For $50,000, the weighted average there is probably close to 3.9%.
Right.
So what that really means is you're paying 3.9% on that total debt.
Wow.
So it's would you rather have that 3.9% blended rate, or go out and get normal financing at 7 or 8%? Clearly, as long as you're educated, you'll understand that.
Yeah, that actually makes a lot of sense, right?
Right.
Who in their right mind would want to go out there and pay 7, close to 8% when you can have this blended rate? Even though one is at 3, one is at 11, you're going to be under 4 in total for the entire loan amount of both of these loans. Wow, that is fantastic, guys. Can you see the information and why this is so revolutionary to obviously the industry now? And this can solve a lot of problems for a lot of buyers and a lot of people. And I'm so happy that Mike and I have been in contact with. He's established a really good team. So anybody that's interested in doing these types of loans, make sure to reach out to us or go to the link that I've been talking about in my bio on Instagram, because we want to get you connected and get bigger conversations with this immediately, because this can really be a solution for you and for your family. But as we continue, what is the actual process like this for going through this? Because I know you said it's not new financing, but it's definitely a screening process.
Sure.
So let's inform the audience on exactly what that is.
So the way that works, the process itself is almost identical to new financing.
Okay.
So for example, people go online, they'll apply, pull credit, take a look at everything, they send in their income documentation. Same type of process. But what happens is, in the assumption world, the guidelines for those are way different. So we call it a pre-screening instead of a pre-approval. So a lot of times that requires a little bit more paperwork. And an example of that is, say for new financing, you might need 1 year of tax returns, but in assumptions, you're always going to need 2.
Okay.
So you might need 1 year of W-2s in new financing, but you're going to need 2 in assumptions.
Okay.
So the guidelines are just different. So it's a different type of pre-qualification. So if you're approved, with say we have a PQF here in Arizona with a lender for new financing, it doesn't necessarily mean that you're going to be qualified for an assumption.
Okay. So pretty much the same thing.
Same
we
process.
want to make sure you have your W-2s, your bank statements, copy your ID, tax returns.
All the basics.
All the same things. Okay.
Yeah.
Now, what about the time one of these assumptions actually takes? Is it traditionally like your 30 days with new financing, or is it a little bit extended longer? What's that process like?
No, it's the Wild West out there.
Wild West, guys. Right?
Right? It's the Wild West out there.
Okay.
So the servicers, and when you'll hear me say servicer over and over, but what a servicer is, it's the seller's current mortgage company.
Right.
That's what a servicer is.
Okay.
So all these different servicers have different time frames. They're not supposed to. They're supposed to get this done in 45 days, but they don't. They simply don't.
Okay.
So you might have VA or FHA or whomever that are going to mandate that they do that, but they just don't have the manpower. So from a turnaround or a closing perspective, you've got to realize that closing date is going to be a target and not a hard line.
Okay.
So on average, we were quoting probably about 60 days, depending on the servicer. Now, the assumptions have gotten super popular, so these servicers are getting inundated with them, and they don't really have very good servicing departments. Okay. So we're probably closer to about that 75-day mark now.
Okay. So you're saying a lot of these servicers don't have the manpower for actually handling those assumptions.
Or expertise.
Okay. Right. But I know you and your wife have been actually going around and talking to a lot of these servicers and making sure that they are up to date and they actually can do this. And your process is helping everybody out, not only us as clients, but also as the servicers as well. Is that correct?
Exactly. So within the servicers didn't like us, meaning our space, for a while. Mm-hmm. And because they felt that our space was really just a bunch of people calling up and bullying them and telling them to go faster. Yeah. And they were right. With some people actually do that. You might have an agent that knew what they were talking about with assumptions. They'd call in and they say, oh, you just got to hurry. You have to get this done in 45 days. Right. It just doesn't work. Okay. We take a much more collaborative approach with the servicers, and they've seen our value with that. So they're allowing us to build teams within their company, basically.
That's awesome.
Yeah. Okay. So we can definitely shorten that time frame, but it's still the Wild West out there.
Fantastic. This is great information. But the last question I really want to ask for, especially the audience of buyers, out there, what is the cost to do something like this? I know with new financing, you have to go with your underwriting fees, processing fees, you have your points, all those kind of stuff, title, escrow. So what is the actual cost? And is there any savings actually going with this route?
Yeah, no, absolutely. So for example, you, me, as assumption specialist, our fee is 1% of the purchase price to the buyer. Okay. And then the other fees that are associated with an assumption is you have the servicer that can charge a fee, but it's minimal. They can only charge $300 for a VA loan. Wow. They actually just got a variance recently, but it hasn't been implemented, where they can charge like an additional $400 and something. Okay. But it's nothing for a servicer. And then FHA can charge up to $900, the servicers can, an FHA loan. Yeah. Now, if you compare that to new financing, the savings comes from, remember, there's no new loan because you're taking over this existing loan. So there's no points to pay. In all the loans these days in new financing are charging points. There's no lender fees to pay. Your title policy for a buyer, you're saving probably about $1,500 there because the insurance of the title is already on the existing loan, so you don't have to reinsure it.
And you also said no appraisal, isn't it?
Yeah, that's right. No appraisal. Okay. Yeah, so that's a key piece.
Yeah. So when you and I were having this conversation, yes, there is going to be a 1% of total purchase price as far as the fee. Right. But the total savings when we have the discussions is usually around 30% on average.
It's about 30%. And that 1% fee, it's only if there's nothing up front. Like you don't have to pay for appraisal up front. That's a huge fee or a huge savings there. Yeah. But then also the 1% fee is only paid through a successful closing.
Yeah. All right. So guys, pay attention to this. So you have the ability to assume a mortgage or assume a loan at a lower interest rate. Mm-hmm. Then you also have the ability to save 30% on costs overall. Right. And then you don't have to go through an appraisal. There's no upfront costs. You only have to pay for this if it actually is successful. Right. The only thing you really have to be prepared for is making sure that you are going to go for the 60 days.
Can wait a little longer. That's about it.
That's patience. Wonderful. All right, guys. Well, this has been such a huge value. Mike, thank you so much for coming and actually having this interview with us. There's tons of value. Make sure if you guys want to know more about this, you can reach out to me on our information in the description below. You reach out to me on social media, or you can go to the link in my bio and you can see all of the active listings that are actually on the assumptions, and we'll talk more about that later. But thank you so much for tuning in, guys, and we'll see you on the next video.